We are Starweaver.
Capital budgeting. What's it all about? Well, our clients take a look at what they want to do to grow or to maintain their present business condition and get new equipment or whatever the decision is, and they want to look at these decisions project by project. The reason for doing that is capital budgeting itself as a term has behind it sort of an assumption that the available capital is unlimited. So I really want to call this subject capital allocation because there are obviously limited resources. And there are also limited resources as far as management is concerned. I mean, how many companies do we see today that have stretched themselves into businesses that they really didn't understand getting into in the first place and didn't have the management team to accomplish it? So we've got managerial limitations as well as financial limitations, therefore the budgeting process. And what we basically look at is cash flows going into the future, and this all lays a foundation for what we will talk about in the next couple of weeks called corporate valuation, a much more sophisticated analytical approach to this subject. That's why, again, capital budgeting, I think, is very fundamental and something we all ought to have in our mindsets before we go into the workshop process. And then we look at these projects. We look at their estimated cash flows into the future, and then we discount those at some rate, typically called a hurdle rate in this scene, and what we will call it later on is the weighted average cost of capital, which I know many of you are familiar with. Okay, now I'm going to go to the next slide and talk about, well, this is really what it's all about. This helps us in studying capital budgeting to get into the mindset of the treasurer and the CFO. Think of it, actually, we're managing investments. So it's like a fund manager managing investments the same way. And we use this cost of capital, or what in the fund manager position, what the expected return is based on the holders of their mutual fund shares. Very, very analogous one to the other. Now, next slide. We looked at this study that Michael Porter of the Harvard Business School put together, interviewing CFOs at 300 companies. It's not necessarily just the cost of the equipment itself. There can be other costs that are generated by a project. Maybe new labor, additional labor would be required, maybe new facilities, maybe new cost of real estate for a new plant. So all of those costs related to this incremental addition to our plant, property, and equipment have to be considered. Okay, then we make some estimates of where we think these returns are coming from. This is very elemental. You'll see towards the end of this module that we'll get a little bit more sophisticated about analyzing these cash flows. But the rudimentary part of them is they're comprised of what's the operating cash flow from the new project, depreciation, okay, which is a non-cash charge but develops a cash-like item for us from a net cash flow standpoint, and obviously taxes, which will be beneficial. Okay, now initially we want to certainly consider uncertainty because the cash flows are all in the future. They're not guaranteed by any stretch of the imagination, and unless you're a fund manager and you buy government bonds, but even there's a question. Okay, so we'll take that into account later on in this program, but we certainly have to consider it. Some projects will be riskier than others in terms of developing the kinds of returns that we're looking forward to. Okay, the next slide we talk about depreciation a little bit. Bear in mind it's not a source of cash, though when we analyze cash flows, we add it back. It's not really cash. So we can look over the life of the investment, okay, as to the effect of these accounting cash flows, etc. And for the life of the investment, it'll be the same. Cash flows and net income we'll consider the same. But during the life of the asset itself, the cash flows and the accounting income may be quite different. And when we get more into depreciation, you'll see how that works. And needless to say, it's going to affect the present value when we discount those cash flows by the hurdle rate. Okay, the simplest form on our next slide of depreciation is what we call line or flat. And all it does is simply take the net investment in this project divided by the useful life of the project. Salvage value is just simply we're going to reduce the cost because we're going to assume we can sell it for something at the end of its useful life. And we divide it by whatever the number of years of useful life is, and there we get our annual depreciation for that project. Now, in the next slide, we talk a little bit about something that's a little bit more sophisticated and is offered, is in terms of U.S. taxation is concerned, this double declining method of depreciation is available to those who want to use it. Straight line is totally accounting. Double declining is for tax purposes. And that's the formula. I don't need to go into it at any great length, but it creates a diagram, a curve, if you will, which we'll see a couple slides from now. And in the next slide, we talk about, as far as the U.S. is concerned, we've got the modified accelerated cost recovery system. We've got various levels of depreciation, and as I'm sure you're familiar, you know that a big old printing press is going to have a heck of a long useful life than an automobile. So we want to take those into account. The IRS has specific tables for specific types of equipment, and all you have to do is look that up and decide what that project or pieces of equipment or just one piece of equipment, how that qualifies for various of these makers. And the double declining method is described further here. And as you'll see further, it's very logical and elemental that one of your clients who's looking at a new project, a new piece of equipment, would automatically want to take double declining, at least for the initial phase of its useful life, simply because you get more bang for your buck. A greater depreciation is higher in the earlier years than it would be by straight line. And this is how you get to it. Though, and about 2/3 of the way through the useful life, okay, if you had been on straight line at that point, you get a bigger deduction. So you're also permitted to switch back to the straight line depreciation in the latter third of the equipment's useful life. Okay, next one. This talks about when you can actually take your depreciation deductions for tax purposes. Originally, just to set the stage, the IRS permitted even equipment that was bought on the last day of a tax year, December 31st, companies could use the full year's depreciation in that year, the last day of which was the purchase date. Well, I guess some bright people in Congress sort of looked at this a little bit and said, you know what? We see a lot of people buying a lot of equipment at the end of the year, and they're getting the full benefit of the depreciation, and they didn't even use it. So we better crack down on these characters. Okay, and then the first level was if you bought it, it didn't matter when you bought it, but then they established this thing called the mid-year convention. Okay, and it just assumes that you put the equipment in at mid-year. Okay, so I mean, you could have bought it in April, you could have bought it in November. They're going to give you only the benefit of a half a year's depreciation no matter what. Okay, so then what happens? Well, then of course, everybody wanted to go and buy the equipment in the mid-quarter, and they said, oh, now everybody's buying it then, and they're taking deductions for depreciation for more of the year than they actually own and use that piece of equipment. So we're going to nail them with this 40% restriction if they buy something in the fourth quarter. Okay, so that's the way it is at present. And again, it was just because they thought, or the country or Congress thought that these companies were being a little bit naughty with their tax deductions. Okay, now the next slide gives you an example of the same investment, $10,000, for different types of equipment that have 3, 5, and 7-year useful lives. And then we're going to take the present value of those future depreciation amounts at a hurdle rate of 8%. And as you can see here, you get a much greater benefit from the useful life being shorter than longer. And that's all that table's really supposed to show. Okay, next one. Now, further rules about depreciation deductibility. In the first bullet point here, if the asset is foreign, used by a tax-exempt entity, or financed with tax-exempt bonds, what we have in mind there are industrial revenue bonds, okay? Then you can only use the straight line method. You're getting another kind of a benefit from a tax standpoint by falling under one of those three categories. We're not going to give you the benefit of double declining depreciation at all. Okay, now the next slide really shows us graphically what happens to the double declining versus straight line method. As you see, the straight line is exactly that. It goes from $100,000 on the day of purchase down to zero, okay, on year 6. Now, the lower curve shows what the remaining life is because we're depreciating at a higher rate, okay, and it's double declining, so it's in effect basically compounding the deduction until you get to, as you see here, year 4. Now, if you stayed with the double declining method, in year 5, your deduction wouldn't be as great as if you were straight lining it. So let's say that looks like year 4.2 is about the break-even level, and a company can therefore take that asset and start using the straight line method because it's to their benefit to do so. Okay, next one. We've got units of production. This is another tool or another formula for calculating depreciation based on levels of production. Okay, you'd see this in the natural resources area. Coal, for example, would be the type of asset that would be depreciating. And this is the formula for that. And it just simply says the C minus S, which is the net value or the net investment, okay, and whatever it's produced, how much ever they produce, say, in a year, divided by the total number of units developed over the estimated life of the project. Okay, now that lays the foundation, a little bit of the math behind capital budgeting. But we have clients, or I had clients, you have clients, who are all looking at many opportunities out there to invest what limited funds they have into different sets of projects. So we need to develop a method for differentiating and comparing these different projects to finally decide, again, with the limited capital that we have, which ones to pick. So we've got a number of different ways to look at it, and none of them really stands out as the right one. And in some cases, it's actually pretty good to use a couple of them and to get an idea of where we're going here. The first, and I'll show you diagrams and cash flows of all of these, but in summary, payback is the first one. It's just simple. The money you develop from that project, what the income is from the project, how long would it take based on those annual incomes to meet the exact amount that you invested in the project. And at that time, when that is a break-even amount, when you've fully recovered your costs through revenue development, that's called the payback period. Needless to say, you want the shortest payback period that you can get. Modified payback just simply takes into account another little level of sophistication higher, the taking into account the actual cost of the financing that the equipment required. Okay, and so then we impose an interest-like penalty on the cash flows to take into account whether we probably, say, used our bank debt to do such a thing. Okay, and lastly, return on investment, a totally different calculation. It's just simply the annual income divided by the cost. Many clients out there, particularly publicly held companies, state right up front in the president's letter that return on investment is how they gauge their entire company. We use it here in the subset of simply looking at a project or a project by project, but it's the same calculation. Okay, now, moving into a little bit more sophistication, net present value or discounted cash flow method can be used here to analyze different projects. We just estimate what the future cash flows are going to be. We take some discount factor, and we'll get into that. What is the discount factor we ought to use a little bit later. Internal rate of return, that's simply to say, okay, to make the cash outflows on a net present value basis equal to the inflows on a present value basis, what is the internal rate of return that will make that number zero? or the net present value is 0. Okay, and that way we get an internal rate of return. Profitability index is also a good one. It takes into account the time value of money by present valuing the inflows, that's the income from the project, divided by the present value of the outflows or the investments in the project. When we speak about the investment amount, bear in mind, throughout this module we talk about outputs, plural. What we're taking into account there, for example, let's say you made an investment in a airplane, okay? But you had budgeted a fleet addition of maybe 5 or 6 aircraft. And you may not take delivery of that aircraft and pay for them all at the same time. So the project would be, the whole project would be the 5 aircraft, okay? And there would be various stages of purchase timing for each one of those 5 aircraft. So we want to analyze the whole project of 5 aircraft, bearing in mind that the investments will come over time and not all be at the front end of the deal. And our first payback chart here on the slide outlines a similar kind of investment where we have 2 outputs, first times 0 now of 20, and then at T1, when we're going to get some income from this project, we're also going to have an outlay of another 30 for a total of 50, say, million for this project here, and these are the cash flows that come out of it. Now, since we can't really interact here, I would normally ask everybody to take a look at the chart and tell us when the break-even is. Well, these are the cumulative cash flows in the final column on the right. You can see that when the amount reaches 0, which is in year 3, that's when the break-even takes place. So this is, you could say, it's a 3-year project in terms of payback. Now, the modified payback example that's here, you'll see the major thing that's added is the 1, 2, 3, 4th row called interest coverage. That wasn't taken into account up front, and we look for the payback here, and you see that we go to 0, but when? Somewhere between the 3rd and the 4th year, going from closing balance of minus 7.5 to a positive of 12.5. So call it, say, 3.7-year payback by the modified method. Okay, return on investment. Now, these are varying definitions, if you will, or formulas for annual rate of return. Then the return on average investment here, another way to look at it is you adjust for the original investment, so you deduct it from the cost of the total income over the period, the time period involved. And again, it's the average, so it's the original investment divided by 2, but in this case, times the time period, okay? Because we took the total income over the whole life, useful life of the project. And lastly, it's the average book return on investment is simply modifying the third one by the new denominator or weighted average investment. Okay, that's to take care of those cases where there are multiple investments made over the useful life of the project. Okay, now the next one, we have another example here of return on investment. And again, there are 2 phases of investment, one to 20, the next to 30 million in T1. And these are the cash flows above the line that we are expect from this project. Now, we have a little bit of a problem here because we have an inflow and an outflow in the first year of investment. So we have a little bit of a problem mathematically dealing with that. And so what we've done here is to say, well, the real income that we're expecting of this project is going to be 20 million annually. The fact that we only got 10 million in the first period probably is simply a reflection that we hadn't made the full investment yet. But after the full 50 is put in, we expect 20. So we've modified the result here a little bit by simply saying average expected annual return from the project is 20, putting in 50, therefore the ROI is 40%. Okay? All right, now what we've simply done here is we've taken the formula that was 2 formulas up is you'll see, because we have the denominator is the 50 divided by 2 times the time period, which is 6 years, and here we get an average book return on the investment of 40%. Okay, and the next method we selected was present value. Here, again, we were having the same type of a project, and we just look at the cash outflows and inflows over that 5-year period of time. Okay, and then we just take the present value of the inflows, okay, and divide it by the outflows. And this is the next slide just simply shows the keystrokes for a financial calculator. And we took a hurdle rate of 15%, and here we come up with a net present value of $20.91 billion. Okay, now the next method, just to show you an example of what we spoke about before, internal rate of return. Okay, now we've got our cash flows here, and what we simply want to do is we want to input the cash flows, okay, and using these keys on a financial calculator, we just have only entered the cash flows and the period of time that these cash flows take place over, and we come up with an internal rate of return of 25.8%. That's what those cash flows would produce given our hurdle rate assumption. Okay, now, example of profitability index. Again, it's just the present value of the inflows, okay, income from the project, divided by the present value of the investments in the project. It's very simple to do. It's very straightforward and gives us an idea, and obviously we would want what? Well, we'd want the profitability index to be larger than 1. How much larger than 1? We can figure out what other projects we're interested in and compare them. Okay, now, to review these methodologies, talk about what's good about them, what's bad, pros and cons of the methods. Okay, the payback says how fast we get our money back, but it doesn't really say anything about what happens after that. It's just very simple. Hey, Fred, when do we get our money out of this thing? So that's when you get your money out of it. Okay, it doesn't talk about any valuation of the investment at all. The project size isn't important, and project size would have to be important. Obviously, if I'm looking at a $7 million project and a $15 million project or an $18 million project, all 3 projects, certainly the amount of the investment would have to be taken into account. Payback doesn't do that. And time value of money, there's nothing there. It's just, hey, Fred, when do we get our money back that we put in? Modified payback is just as bad, except we cover the time period a little bit better by adding some cost of capital, whether it's bank debt or whatever it may be, into that. So it's a little bit better, let's say, theoretically, than plain old payback. In terms of return on investment, we do see, as long as our predictions are pretty good, the whole project life was part of the calculation in any event. But again, the size of the project, the time value of money, just like payback, are not considered, not taken into account. And they don't really talk about cash flow per se. It's net income, okay? So that may or may not be how we want to define it. When we do corporate valuations, we're going to have a different definition of cash flow there than even here. Okay, now, present value, okay, time value of money is good for that. It doesn't say anything about the other projects. We'll come up with a number that's based on the size of any one project, but then if we have another project, for example, which is larger in size, it's naturally going to have a higher present value simply because of its size, or size will influence that net present value, and therefore the 2 projects won't be really comparable, or comparable in deciding which between the 2 based simply on net present value. Okay, now we come to pros and cons of internal rate of return. Okay, we get a good feel for time value of money because it's a discounting calculation. We get a return figure against the hurdle rate, which is good. That hurdle rate can be anything. I mean, it could be the cost of money. It could be just an imposed hurdle rate that would include maybe their cost of capital plus some additional premium over that, giving some consideration of the riskiness of the project. Okay, it doesn't. We don't say where the shareholders get anything out of that. And we have, with multiple outflows, we're going to have a number of different IRRs. Again, if we have varying amounts of investment over a different time frame, those numbers can be distorted and not be comparable to other projects we're looking at. Okay, now, a couple of ways to deal with some of these disadvantages or drawbacks of these methods. Let's take a look at what we can do in terms the projects are unequal. Okay, let's say we have a project we say is going to be 4 years in useful life and another that's 7 years in useful life. What this formula does is it makes the assumption that the 4-year project will be repeated until the 7th year when the lengthier project life is over. And this formula helps us do that. And all it does is regenerate the same number of returns out that additional 3 years, so that in the time frame we make them mathematically comparable. Okay, so that's one math way to do the disparity in useful lives. Now, we mentioned a couple minutes ago about the fact that, well, we've got a project that's 20 million, 3 million, 7 million, whatever it is. We can't use net present value and compare those results amongst those 3 projects and come up with anything that makes any sense, simply because the difference in size of each of those projects is going to impact the overall size of the net present value calculation. So here's what we do for that mathematically. We take the net present value of any one project that we've calculated, and then we divide it by the present value of the investment. Okay, so that way we can compare one project to another project in adjusting them both for differences in actual amounts. Okay? Mathematically, if we've got both of those situations involved, the useful lives and the amounts aren't the same, then the rule is we adjust first for the life, okay, and then for the size to have comparable results. Okay. There are other things that we have to think about, too, that are, in some cases, quantifiable, but in other cases, there are risks that are out there that can impact either the amount of the investment or the cash flows that come from the project. And here's just a few of them. Regulatory requirements. But what I have in the back of my mind for that would be, for example, let's say we had heavier laws against coal-fired electrical plants emissions, and that these higher restrictions on coal-fired electric plant emissions caused a capital budgeting situation to arise at those utilities. Okay, so whatever scrubbers they have now, they have to be improved upon, and there's going to be an investment that's required for that. Okay, so this may be a plus, minus, or binary decision. These might be regulations impacting electric utilities that they can't do anything but make an investment about. Okay, so maybe they have some other projects they're looking at. This one has to come to the surface because it's a governmental requirement. They have to put in these better scrubbers, then build a new plant or get some more trucks or whatever. Labor relations, again, this could have an impact if we're going to have a strike or we know the contract's coming up in the near future and these workers are going to be on one of our new projects. We have to take into account the risk that, on our cash flows with that. Technological change, okay, maybe we're going to be obsolesced out of our existing technology by another one. We have to take that into account, make adjustments in our cash outflows, inflows because of that. Whether we'd have an image problem, do we really want to invest in that great big old jumbo jet, which can't fly into 70% of the airports in the world? It's a gas guzzler. Do we want to think about that? Maybe we'll do something that will really tick off our shareholders. Better consider that. And similar things. Again, some of these are, in fact, quantifiable, but others will create a risk that we'll have to make some adjustment or take into account, and we'll get into some of those ways that we can actually make those adjustments further on in this discussion. Okay, what can we estimate on the next slide, further on the qualitative factors? You can think about, I've given you the two examples here, and they are problems. Okay, now, what we haven't talked about are quantifying risks. If we can in some way do that, obviously our resulting capital budgeting level of sophistication will rise considerably. Risk of the uncertainty. Okay, probability of expecting results. I'll show you in the next few slides how we can take care of that one, the uncertainty. We can also look at any project and do sensitivity analysis, use statistical methods, simulate the actual project itself through some means physically, and judge it by that model. Okay? And we can adjust the cash flows that we have through the sensitivity analysis, and we can also play with adjusting the hurdle rate. I take a break here. We do have one question so far, and that is, and we welcome them, by the way, and that is, will you need to bring a financial calculator to the workshop? This has been a growing request. I guess when I started at GlobeCon, it was you couldn't have a finance workshop without a calculator, and I think there are a lot of people who are sort of concerned about that. I have to explain to you, however, that yes, in fact, financial calculators, or if you bring in a computer with Excel spreadsheet, will be useful for our time together a couple weeks from now. Okay, so definitely bring in a calculator. Okay, so now let's get into some ways we can actually make these adjustments. Probability adjusted cash flows. Okay, now state 1 and state 2. What we mean by state 1 and state 2 are one assumption. Okay, we're going to invest in state 1, one project, 150 million, whatever, and that has a 70% likelihood of achieving a cash flow of 105. Okay, and we have another project which is only going to require 100 million investment. Okay. But it only has a 30% likelihood of achieving a cash flow of 30 million. Okay? So the probability factors that we put in here are to take into account the success factor. Consider it this way. If there's more volatility in the expected cash flows, that means what our expectations are, there's a wide range of possible values there, then these probability factors can help us a little bit with the understanding what the expected cash flows from those are. And here we have, okay, though the result there is 135 million. The next slide shows a decision tree, and those of you who haven't seen a decision tree before, I'll try to explain it. You see, we start at the far left, and what we're saying here is that we have an opportunity to invest 200 million and another opportunity to invest 100 million. At this particular point in time, we don't know which one we want to do yet, so we give them each a 50% chance of happening. Okay, then we move to the next nodules, okay, and the branches from there on the top side get an 80% chance of achieving the 110 and a 20% chance of achieving the 142. And further left, in the last branching, we get a 50-50 chance of getting the 80 or the 121, and so forth throughout the tree. And so this is a way also to take into account, just diagrammatically, these changes in, well, present value effects as well as likelihood of success. And on the next expected cash flow table, we create a very complex decision tree. Here you see this. We have actually 6 different possible events for levels of investment, and we do the present valuing of those, and we take it over a 2-year period of time. Okay, and as you can see here, we have the expected value of the 2 groups of free net after the discounting and the probability analysis broken out that way. Okay, so these 2 refinements add another layer of sophistication to what we saw early in the model was a very rudimentary way of looking at cash flows. Now lastly, what I want to make you think about a little bit is how would we modify that hurdle rate given the comparative riskiness of achieving those outflows? And what I'd like you to do is let's just take, for example, a diversified oil and gas company. And we have this required level of return versus risk, straight line. And we're saying the risk-free rate, which when we get into corporate valuation, those of you who've had it before, would be 7. So that's really a long-term government bond. Hopefully our long-term governments will stay at a AAA. Next up from that, it's more risk because it's only a AA corporate. Pay a little bit more for that. And let's just say the company's weighted average cost of capital is around 13%. But we're in the oil and gas business. Okay? We build refineries, I hope. We have an offshore platform drilling that we may want to buy. And we also may want to invest some money in oil exploration. But as I'm sure you can, common sense would tell us all, that if we make an investment in a refinery, we're not going to do it unless we get the crude that's going to be put through it economically. But assuming we get the crude oil supply to need the refinery, then the risk of achieving cash flows from that are relatively small given the industry that we're in. Okay, so we have another opportunity to expand by building offshore platforms in the Gulf or wherever. Okay, that's going to have a little bit more difficulty in achieving its results because the results are not as well known as the results from building a refinery. Likewise, we have an opportunity to invest in exploration, and it too has even a higher level of risk of obtaining the cash flows in the future than the offshore platform or refinery investment would make. So we could even refine our estimate of the present values of these projects and the like by simply saying, well, the project is going to be a little bit riskier than other projects that the same treasurer and CFO are looking at, so let's make an adjustment in our hurdle rate in order to differentiate between them, giving risk of likelihood again as a factor. So anyway, this is, I think this lays a good foundation for us, and the philosophy that we're going to try to have throughout the workshop programs, and that simply being that how does our client make decisions? This is the first step in the decision making. This is the decision, the internal decision as to what to invest in projects. And again, as we get into the workshop environment, we're going to be at the other side of that decision by providing the right combination of financing that they need for those projects. But now we've laid the foundation for understanding how they come up with their decisions to spend how much money on what.
Thank you for your participation in this program. We are Starweaver, education you can bank on. For more information, contact us.